Hi everyone, today we'll be going over accounts May-June 2020, paper 3.3, question number 2. This is structured paper 3 which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes. And this question number 2 is a part of section A which relates to financial accounting. Now without any further delay, let's get started. AD Limited sells watches and clocks. Watches are manufactured by the company and clocks are bought from a local manufacturer. Alright, then the following balances were extracted from the books of AD Limited at 31st December 2019. First of all, let's have a look at our first question. We need to state the meaning of the term work in progress. Alright, let's do that. So we know that work in progress are goods in the process of production that have not yet been completed. Let's write it down. Work in progress are goods in the process of production that have not been completed yet. Alright, now for the second part, we need to state how work in progress is valued. Since work in progress is also a kind of inventory, we need to value it at the lower of cost and net realizable value according to our International Accounting Standard 2. Let's write it down. Valued at lower of cost and net realizable value according to International Accounting Standards 2. Okay, so this concludes the first part of this question. Now we can move towards the second one. We need to prepare the manufacturing account for watches, since only watches are manufactured and the clocks are bought in from another supplier, for the year ended 31st December 2019. Okay, so let's prepare our format. So that's manufacturing account. For the year ended 31st December 2019. So whenever we're preparing a manufacturing account, we always start with our direct costs, right? And the major direct cost would be that of raw materials. And the format for including our raw materials is similar to that of cost of goods sold in our income statement that we used to do in our AS level, right? We used to include the opening inventory, purchases, and our closing inventory, as well as the carriage inwards related to it. So we will be starting with our opening inventory of raw materials. Let's have a look at the given information. Okay, we are given inventory at 1st January 2019, which is actually the opening inventory, right? And we are talking about raw materials. So the opening inventory of raw materials amounted to 12,500. Let's include it in our manufacturing account. So that's the opening inventory of 12,500. Then we move towards purchases, and purchases are added. Let's have a look at the information again. You can see our purchases of raw materials right here, and it amounted to 132,700. So let's include it in our manufacturing account. That was 132,700. Then we subtract the closing inventory. Let's have a look above. We are given inventory as 31st December 2019, which is actually the closing inventory, and we're talking about raw materials. So the closing inventory of raw materials amounted to 13,400. Let's include this in our manufacturing account. So that's 13,400. And we need to subtract our closing inventory. So that's a bracket. Let's have a look if there is any other expenses relating to our raw materials. Okay, I think we've included everything. So now we can move towards figuring out the cost of raw materials consumed. Okay. Cost of raw materials consumed. That is just going to be the sum of these three amounts. So that's 12,500 plus 132,700 minus 13,400, which results in the value of 131,800. Now we just have to add other direct expenses. Let's have a look above. Okay, then other direct expenses would be of direct wages, and it amounted to 168,000. So let's record it in our manufacturing account. That's direct wages of 168,000. Okay, let's see if we have any other direct expenses. So there are manufacturing overheads, rent and rates, administrative expenses. Okay, so these are all indirect expenses related to the factory, which means that all of our direct expenses are already recorded. So we can move towards figuring out the total of the direct expenses, which is also known as the prime cost. Okay, now the prime cost would just be the sum of cost of raw materials consumed and the direct wages, which is 131,800 plus 168,000, which results in the value of 299,800. Okay, now the next step would be to add all of our indirect factory costs. So let's have a look at the above information. Like I said before, the manufacturing overhead is actually the indirect factory expenses, right? So the amount of 63,500 should be included to our prime cost now. Let's do that. So that's manufacturing overheads. And this amounted to 63,500. Okay, let's have a look at other indirect expenses. We are given rent and rates, and we are given additional information relating to rent and rates. So prepaid rent and rates at 31st December 2019 were 4,000, meaning that this 4,000 relates to future rent and rates, which should not be included in our current expenses, right? So we need to subtract this value of 4,000. So this gives our rent and rates for this year to be 64,000. Then we are also given that rent and rates are allocated between manufacturing and administrative expenses in the ratio of 3:2. So out of 5 parts, 3 parts is allocated towards the manufacturing. And since we're talking about the manufacturing account, we require this value, right? So for manufacturing account, that's going to be the total of 64,000, right? And out of 64,000, 3 out of 5 parts is the manufacturing overhead. So that's times 3 by 5. So this gives the rent and rates allocated to our manufacturing expenses to be 64,000 times 3 by 5, which results in the value of 38,400. Let's include it to our prime cost. So that's going to be rent and rates of 38,400. Let's have a look at the information again. Then we are told that depreciation is to be provided on plant and machinery, and the depreciation rate is 25% using the reducing balance method, meaning that this rate of 25% is to be applied to the net book value of plant and machinery rather than the cost. Let's have a look above. So we can see that the plant and machinery is right here, and at cost it was 320,000, and we can see that the accumulated depreciation for plant and machinery is 184,000. So depreciation charge is just going to be the net book value, which is the difference between cost and accumulated depreciation. So that's the cost of 320,000 minus the accumulated depreciation of 184,000. This gives the net book value. Now we can multiply it with the rate of 25%, which is 0.25. So this gives our depreciation on plant and machinery for this year to be 320,000 minus 184,000 times 0.25, which results in the value of 34,000. Again, this is a factory overhead, so let's include it in our manufacturing account. And that is depreciation on plant and machinery. With the value 34,000. Again, let's have a look above to see if there is any other indirect factory overheads. Okay, I think we've included everything, so now we can figure out the total of the prime cost and the factory overheads. And that is just going to be the sum of these four amounts. So that's 299,800 plus 63,500 plus 38,400 plus 34,000, which results in the total of 435,700. Okay, now we can see that we have not actually included any work in progresses, right? So what we do is we always add the opening work in progress and we always subtract our closing work in progress. So let's look for its value in our above information. So our opening inventory is given right here, and we can see the watches work in progress has the value of 9,000. So let's record this in our manufacturing account. So that's 9,000. Now we look for its closing value. And the closing inventory of watches work in progress amounts to 9,700. Again, let's include this in our manufacturing account, and we know that the closing inventory is actually deducted. So that's 9,700 in a bracket. Okay, now we can figure out our manufacturing cost. And the manufacturing cost is just going to be the sum of these three amounts. So that's 435,700 plus 9,000 minus 9,700, which results in the value of 435,000. Okay, and whenever we're preparing our manufacturing account, we always include the transfer value, right? And the transfer value obviously includes the factory profit, which means that we now need to add the factory profit. So let's have a look above. We might have information regarding the factory profit rate. Okay, manufacturing watches are transferred to the trading account at production plus a markup of 20%. So this 20% is actually the factory profit. Let's figure our factory profit now. That is just going to be 20% of the manufacturing cost. And we know that our manufacturing cost is 435,000. And 20% of it, we can just multiply it with 0.20. This gives our factory profit to be 435,000 times 0.20, which results in the amount of 87,000. Now we can add our factory profit to the manufacturing cost in order to figure out our transfer value. And that is going to be 435,000 plus 87,000, which results in the value of 522,000. Alright, this concludes our manufacturing account as well as the second part of this question. Now we can move towards the third one. We now need to calculate the gross profit for the year ended 31st December 2019 on the sale of watches and clocks. Okay, so whenever we're talking about figuring the gross profit, we always start with our sales value. So let's have a look at the above information. We can see that the sales revenue for watches amounted to 628,000, whereas sales revenue for clocks amounted to 332,000. Let's write these two amounts into our statement. So for watches, it was 628,000, and for clocks, it was 332,000. Okay, now we just need to subtract our cost of sales. So that's going to be the opening inventory. Let's have a look above. Okay, whenever we're talking about opening inventory while figuring out the gross profit, then we actually are referring to the opening inventory of finished goods. So we can see that the finished goods of watches at cost is 40,000. And we know that whenever we are talking about a goods manufactured within a company, the opening inventory is actually added at the cost plus the markup. So we know that the markup rate is 20%. Let's figure out the markup for our opening inventory. That's going to be 40,000 times 20%, which is 0.20. So that results in the value of 8,000. So now we can figure out our opening inventory to be cost of 40,000 plus the markup 8,000, which results in the value of 48,000. Let's record this in our statement. And this is the value of the opening inventory for watches. That is 48,000. Okay, let's look for the same for clocks. We can see that the opening inventory for clocks is 28,400, and since this is bought in from another supplier, the value does not change. So we just need to record this amount of 28,400 as the opening inventory of clocks. 28,400. Now next would be to add our purchases, but in case of watches we are manufacturing it, so we will be adding the transfer value, whereas for clocks that would be purchases. So we already figured out the transfer value for watches in our manufacturing account to be 522,000. So let's record this value. Now let's look for the purchases of clocks in the above information. So we can see that purchases of clocks actually amounted to 252,600. Let's record this value into our statement. That is 252,600. Now the last step would be to subtract the closing inventory. Let's have a look above for the closing inventory of watches. Okay, we can see that the watches is given right here, and like I said before, we are referring to finished goods, and this is given a transfer price, meaning that this actually includes the cost plus the markup. So we can directly put this amount into our statement. Let's do that. So the closing inventory for watches is 54,000. And since we subtract the closing inventory, I'm just going to write it in a bracket. Now we look for the same for clocks. Okay, we can see that the closing inventory for clocks had the value of 29,600. Let's write this. That is 29,600. Again, since we are subtracting the closing inventory, this should be in a bracket. Now we figure out the total for our cost of sales. So that's just the sum of these three amounts. For watches, that's 48,000 plus 522,000 minus 54,000, which results in the value of 516,000. And for clocks, that's going to be 28,400 plus 252,600 minus 29,600, which results in the value of 251,400. Okay, now we just need to subtract the cost of sales, so I'm just going to write it in a bracket as well. So now we move towards figuring out the gross profit. Okay, gross profit is just the difference between the sales and the cost of sales. For watches, that's going to be 628,000 minus 516,000, which results in the value of 112,000. And for clocks, that's going to be 332,000 minus 251,400, which results in the value of 80,600. Okay, so this concludes the third part of this question. Now we can move towards the fourth one. We need to prepare an extract from the income statement for the year ended 31st December 2019, showing the gross profit, the manufacturing profit, and the adjustment of the provision for unrealized profit. Okay, so we will start with our gross profit. And we have our gross profit right above, so we actually need to add the gross profit from watches and clocks. So that's 112,000 plus 80,600. This gives the total gross profit to be 192,600. Okay, then we are told that we need to show the manufacturing profit as well, meaning that the manufacturing profit should be added back. And this manufacturing profit is added back because in our transfer value, we actually include the manufacturing profit, right? And we can see that the transfer value is being subtracted as a part of the cost of sales. So while subtracting the transfer value, we are also subtracting our factory profit, which should not be the case. So in order to reverse this effect, we are just going to add back our manufacturing profit. So let's have a look at our manufacturing account. We added our factory profit right here and it amounted to 87,000. So we just have to add this amount of 87,000 back to our gross profit. Let's do that. We have 87,000. Okay, then the last part was the adjustment of the provision for unrealized profit. Okay, let's have a look above. We know that for the opening inventory, we figured out our markup. And this is actually the unrealized profit related to the opening inventory, right? That's of 8,000. And now we need to figure out the same for our closing inventory of finished goods. So since this is a transfer price, this includes cost as well as the markup, right? Cost plus markup. And we know that the markup is of 20%, meaning that markup is just the 20% of cost. So we can just write it down as 20 times cost. And this gives our transfer value of 54,000. Okay, now we can easily figure out the cost. If we take cost common, that's going to be 1 plus 0.20, and this gives 54,000. Okay, then the cost is just going to be 54,000 divided by 1.20, which gives our cost to be 45,000. So now we can figure out the markup or the profit or the unrealized profit. So we know that this term is the profit, and in order to figure this out, we just need to subtract our cost from the transfer value of 54,000. So that's 54,000 minus the cost of 45,000 that we just figured out. So this gives the profit associated with the closing inventory of finished goods of watches to be 54,000 minus 45,000, which results in the value of 9,000. Okay, we can see that our opening value of unrealized profit was 8,000, whereas the closing value of unrealized profit is 9,000. So there is definitely an increase, and the increment is of 9,000 minus 8,000, which is 1,000. So whenever there is an increment in unrealized profit, it should be treated as an expense, meaning that in our extract from income statement, we need to subtract this 1,000 under the heading of increase in provision for unrealized profit. Let's do that. Okay, so that's increase in provision for unrealized profit, and it amounted to 1,000. And since this is an increase, this needs to be subtracted. Okay, so this concludes the fourth part of this question. Now we can move towards the fifth one. We need to explain the accounting treatment in the income statement and the statement of financial position of the provision for unrealized profit. We need to support our answer with reference to the accounting concepts. Okay, so what we know is that the profit is unrealized because finished goods have not been sold to third party yet, right? Let's write it down. Profit is unrealized because finished goods have not been sold to third party, and we also know that the increase or decrease in provision for unrealized profit is adjusted in the income statement. Let's write it down as well. Increase or decrease in provision for unrealized profit is adjusted in the income statement. and this is adjusted to represent that both the opening finished goods inventory and closing finished goods inventory are stated at cost rather than their transfer value. Let's write it down as well, representing that both the opening finished goods inventory and closing finished goods inventory are stated at cost. Then in case of the statement of financial position, the provision for unrealized profit is deducted from the transfer value of finished goods inventory in order to reflect the cost of the finished goods inventory. Let's write it down as well. Provision for unrealized profit is deducted from the transfer value of finished goods inventory in order to reflect the cost of the finished goods inventory. And we were also told to refer to the accounting concepts, and these are in compliance with the prudence concept, realization concept, and the consistency concept. Let's write it down. Prudence concept, because prudence concept states that the profit should not be overstated, right? Then there is realization concept. Realization concept states that profit should be recorded once realized. And there is consistency concept, since we are to provide for the provision for unrealized profit every accounting period. Alright, so this concludes the fifth part of this question. Now we can move towards the sixth one. We are given additional information. The directors are considering whether they should stop selling watches and sell only clocks in the future. Now we need to advise the directors whether they should sell only clocks in the future. We need to justify our answer with reference to the calculations in part C and D. So the very first basis would be to figure out the gross profit margin. Let's figure the gross profit margin for clocks. And clocks is just bought in from another supplier, so this is fairly easier to calculate. So we can see that the gross profit for clocks is 80,600 and the sales revenue was 332,000. So let's figure out our gross profit margin. That's the gross profit of 80,600 divided by the sales revenue of 332,000 times 100%. So this gives the gross margin for clocks to be 80,600 divided by 332,000 times 100%, which gives the value of 24.28%. Now we figure out the same for watches, but since this is manufactured, this is quite difficult. We have the gross profit of 112,000 and the selling price of 628,000. Let's write these down. Gross profit of 112,000 divided by the sales price of 628,000. And we also need to adjust our factory profit as well as the unrealized profit. So we can see that the factory profit was 87,000. We need to add it. So that's plus 87,000. And we need to subtract the increment in the provision for unrealized profit and add the decrement in the unrealized profit. And we can see that there was an increase in provision for unrealized profit, and that increase was of 1,000, meaning that we need to subtract this. Let's do that. So that's minus 1,000 times 100%. So this results in the gross profit margin for watches to be 112,000 plus 87,000 minus 1,000 divided by 628,000 times 100%, which gives the gross profit to be 31.53%. We can see that the gross profit is higher for watches, which means that we can write that the selling watches is more profitable than selling clocks. And they're considering if they should sell only clocks in the future, but we know that watches and clocks may be complementary to each other. Let's write it down as well. And we know that clocks are bought in from a supplier, whereas watches are manufactured on our own. And we know that quality can be ensured for own manufactured goods. Let's write it down as well. Quality can be ensured for own manufactured goods. Alright, now based on these factors, we now need to advise the directors whether they should sell only clocks in the future. So we can clearly see that watches produce more profit, and we can check quality if we produce goods on our own. So I would definitely advise that they should not sell only clocks in the future. Let's write our decision clearly. So we can write it down as the directors should not only sell clocks in the future. Okay, this concludes the 6th part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.